Hi everyone, welcome back. Today we're going over ExxonMobil, one of the powerhouses in the energy sector, under stock ticker symbol XOM and currently trading at $104. Now, this company, as we can see in some of the data given to us by Yahoo Finance, we can see that it is currently trading under its 52-week low. They have a really nice PE ratio at 10.33, earnings per share at 10.07, and a dividend yield of 3.65. Now, this company also in its dividend history, we can see that they have a phenomenal 25 years of dividend growth and 41 years of consecutive dividend payments. And this company just in the last 10 years has grown their dividends all the way from 57 cents till 95 cents. That's almost double. Also, it is estimated that the company keeps growing their dividends over time. Now, what caught my attention in the company was the recent news. As you can see, they want to start drilling for lithium and expect to begin productions by 2027. Also, they want to become a top EV stock by 2030. The ambition is there. And the most recent news, despite the title, we don't go with the headlines, but this is really accurate. They have a strong upstream presence, a robust balance sheet, truly integrated business model, and Exxon aimed to become a leading lithium producer. If we're buying the company at a discount and sell it at a premium, let's say in 2027 or 2030, we could be seeing an upside of maybe even 100%. Who knows? We are going to do a valuation, but before we move on to that, I'm just going to show a little comparison right here. Why Exxon is one of the top ones. And as you can see, we have Chevron, Oxy, MVP. And what I like to see here is the annual sales. And as you can see, they by far are the one with the biggest. Also, we can see that they are the ones with the lowest PE, which is great news, except for BP. Now, moving on to the spreadsheet where we are going to evaluate it. But before we begin, if you like my spreadsheet, you can just go to my Patreon page. There you'll be able to download it, have full access to it, keep a copy for yourself, and do the same thing for other companies that you're intending to buy some shares of. Also, if you like the video, please hit the like button and subscribe. It would be much appreciated. So we're going to zoom in right here. Now, once we plugged in the stock ticker symbol, we can see that the 2-year chart, it's looking pretty good. And looking at this data that we have right here, we can see, let me just zoom in a little. We can see that it is currently trading at its 52-week low, as we've seen before. But what we have over here is the return on equity, return on investment, and the margins. Okay, I really like to look at this data, and we can see they have a nice 21% on return on equity, a 17% on return on investment. And on the margins, what I like to see the most is the profit margin with an 11%, near 12%. Above 10% is really good. I think they have a phenomenal balance sheet. Also, what we have over here is the price targets of some of analysts. We have UBS, we have Goldman, and their target price is from 125 to UBS being at 144. But the average target price of all of these companies, Credit Suisse at 125 as well. The average comes down to 126. Okay, $126. That's the average 1-year target estimation that they are coming with. Also, what we like to see here is the sector average PE. We have more data over here, but the one I like to see the most is the average PE. I like the company that I want to buy shares of to have its PE really close to the sector average. And we can see that the average PE in the energy sector is currently at 8.38, and we know that Exxon has a PE of 10.05, if I'm not mistaken. And so it's pretty close. It's a little above, but nothing big. It would be a red flag if it was at 20, 25, but being at 10 really close, it's a good sign. Now we're going to move on to our valuation sheet. And as you can see, we have all the valuations we have to do here. As you can see, we're going to go over this right now, and we're going to start off with a discounted cash flow valuation. Um, we did plug in a stock ticker symbol XOM, and all of the data in blue automatically filled in. All we had to do was check if the 10-year risk-free rate was correct, and then just plug in the past free cash flow of the company of the last 10 years. We have the links all the way here. And once we did that, we got the growth rate. Now, the growth rate got a little messed up. As you can see, due to COVID, it really messed up the free cash flow of the company, and it gave us a not usable growth rate. I'm just going to show you right here what it gives us. So it gave us a negative 79, as you can see. That's what it gave us using this growth rate. And this is completely wrong. It's not accurate at all because taking in consideration COVID really took a hit on most companies, especially ExxonMobil. So what we do, we have to project what we think the company will grow in the coming years. And I did use a 5% for all my valuations. That's actually being pretty conservative, considering that companies like this go by around 10%. But as you can see, it's giving us an intrinsic value of 114, which seems very accurate to me. Then we had the unlevered discounted cash flow valuation. All we had to do was get the enterprise value, net debt, and this data automatically fills in and gave us an intrinsic value of $97.99. Then we moved on to the PE-based valuation, which is one of my favorite valuations. It takes the 5-year high PE and the 5-year low PE along with a growth rate and averaging it down, and it gave us an intrinsic value of $118. Plus, it gave us a 10-year future intrinsic value of 308. Now, this means that the company within 10 years could reach this price. It doesn't mean it's going to take 10 years. It means that within 10 years, it could reach this price, which would be really good. Now we have the dividend discounted valuation. And what we do here is take the dividend payouts and we get the yearly dividends, and it gives us a growth rate. So the growth rate comes to 2.62. We used our growth rate projection and it gave us an intrinsic value of $102. Then we moved on to the multiples valuation, and what this does, it takes the PE of its competitors. So we have Chevron, Occidental, Shell, and Suncor Energy, and it takes its PE, averages, gives us an average, and we come up with an intrinsic value of 9306. Then we moved on to another of my favorite valuations, which is the discounted earnings valuation. It takes the earnings per share, the growth rate, and the PE times 2, and it gives us a future earnings per share within a 6-year target, and giving us a future intrinsic value within 6 years. And all we have to do is bring it to the past to give us to the present, sorry, and it gives us a present intrinsic value of $174. And the last valuation was Benjamin Graham's formula. What we do here is we put again the projection, the growth rate projection, and check if the AAA corporate bonds is correct. And it gave us an intrinsic value of $94.68. Then we did Lynch's valuation. This is just for confirmation. It's like a back test to see if our valuation is actually credible. Now, the earnings, future earnings per share, I did put 10. Now, because on Yahoo, if we go check, it gives us like a 40%. And as you can see, it would be considered very undervalued, but I do like to be conservative, so I go with 10. And it gave us a 1.31. and we will be touching in this in just a minute. But before that, we had to do now is check the ratios. They all came out good. We just plugged in the data in green, and it gave us either a bad or a good ratio, and all the ratios came out good. The dividend safety of 36.78 is also looking pretty good. It's at a B. And we come to the final valuation with the average of all the valuations, and it gave us an intrinsic value of $116. I typically don't use Graham's valuation. I only use it if one of these comes out with a negative number, or it gives me, or I don't have sufficient data to do one of these valuations. That's the only time I use Benjamin Graham's formula. With this, we know that it is currently above 11% of its current value. Also, with a margin of safety of 20%, we get an acceptable buy price of $93. Now, I did already buy some positions in it. I do think it's at a fairly valued, and like I said, 116, it's only 11% above its current value, and that's where this confirmation comes in. It's considered fairly valued, so it would mean that we are accurate with our valuation. I did buy in already some shares. I'm doing dollar cost average. I already put in 40%, and the reason for that is that it touched one of these green lights, a buying zone. It went up, and then it started coming down. Now, if it reaches the purple zone, I will buy 35% more. That would be in the range of 100. Yeah, 199. And then if it comes to our acceptable buy price of $93, then I will put in 25%. So with this, we are over with the video. I hope you enjoyed it. And as always, if you like my spreadsheet, you can just go to my Patreon page. The link will be down below. There you'll be able to download it, have full access to it, and do your own research on it. Also, hit the like button and subscribe. It would be much appreciated. And leave some comments below. Let's have a discussion. Once again, thank you very much, and see you next time.